my inflation is different from yours and different from all the listeners here. So the idea that inflation is one single number is part of the game. Okay, they're trying to make us believe that inflation is this one thing, very precise, 2.0754. No, it's not a single number, and that's point number one.
Hello and welcome to Soar Financially, a channel where we discuss the macro to understand the micro. My name is Kai Hoffman, I'm the @JR Mining guy on X, and of course your host of this channel, and I'm looking forward to welcoming a first-time guest to the program. It's Diego Parrilla, and he's a best-selling author. You might have heard The Anti-Bubbles or The Energy World is Flat. He's also a guest lecturer over at the Imperial College in London, and he's a chief investment officer over at Quadriga Asset Management. Somebody who's got wide-ranging knowledge of the markets, and we're going to tap into that. His book title, The Anti-Bubbles, already gives it away, what we're going to talk about. Bubble behavior, bubble investing, and how do we protect ourselves, and what are some potential solutions to the overall crises that we're seeing in the world. So buckle up. It's going to be an interesting and fun conversation. I just had the pleasure of chatting with Diego for a couple minutes before hitting the record button, and we got some interesting topics lined up that we'll go into. Before I switch over to my guest, about 80% of you watching are not subscribed. Please change that. It helps us out tremendously, and we do appreciate it a lot. So thank you so much for that. Now, Diego, it is great to have you on the program. Thank you so much for joining me. Buenos dias.
Muchas gracias. It's my pleasure to be here, Kai. Thank you.
Yeah, really looking forward to this. It's great to have you on the program, and maybe to gauge where your head is at and where this conversation will be heading. Give us a bit of an overview. What's your assessment of the economy and the financial markets right now?
Well, I think we're entering a new phase. Obviously, Trump and the tariffs, I think, are a bit of a game changer, and potentially we're heading into what could be a perfect storm, I think, for hostile markets. If you think about what it means as the tariffs, I mean, first and foremost, whilst there's a lot of debate, I think they're very inflationary. And that's point number one. It's probably one of the weaknesses of the system is it's higher inflation, because it prevents central banks potentially from easing, which is much needed. The second thing is bringing a lot of uncertainty, and I think this is if that uncertainty holds on for a while, there very clear precedents and studies that show that it has a direct impact on investment, on economic activity, and I think it can also hit on volatility, and we're already seeing volatility picking up in markets. I think FX is particularly picking up. Markets that historically have been much more muted, we're seeing big moves. And I think volatility is contagious. So if you look at the combination of inflation, lower economic growth, and volatility, I think it's a triple whammy that can actually compound into an interesting situation. I think that looking at that historically, we've seen 60-40 balanced portfolios being this idea that you're going to be offset by each other, but precisely the manipulation of monetary and fiscal policies, and the risk of what we call core drawdown, which is fixed income down and equity down at the same time. Effectively, what we saw in 2022, it's that Achilles heels of financial markets, because it exposes a lot of false diversification and hidden leverage. So as we do that, and you add volatility in the mix, and potentially geopolitics and other dynamics, it's not a very healthy environment. If you add other big drivers that have been fueling the market, such as AI and the AI bubble, I think there's a lot of similarities to 2001. It's pretty obvious that it's a game changer technology. The world is going to be, there's a before and after what we're seeing. But having said that, we know that the markets can go, these technologies can attract a lot of capital. You can create significant overcapacity. We're already seeing, multiple competing products and things that theoretically, and the valuations are telling you, like with Nvidia or others, that there's a lot of beliefs that have been driving these huge valuations that are starting to be challenged. And I think as you have this game changer technology with the huge investment, huge capacity, you could eventually lead to almost overcapacity, as we saw in the dot-com bubble and others. And that can effectively take a lot of valuation from a lot of write-offs in assets that eventually will result in a flatter world, in a world where we'll have big winners and losers. But I think those headwinds that we had from this technological move are starting to fade a little bit. And I think that could be exposed also by this pickup in volatility and positioning. So it's certainly a period to be prudent. At the same time, as I always say, mommy and daddy, central banks and governments know this well. They know, and we're seeing, just Germany in the last couple of days going again with another historic move, basically looking to lift some of the debt limits and going heavy for defense and others. So in a world where governments and in general the world is very indebted, can we take even more debt, and where's that going to be funded from, and how are we going to cope with higher yields? And I think there's no question that in my mind that central banks will have to step in and print more money, and yield curve control will be one of the mechanisms that I think will be required to contain the surge in yields. And this brings us back to inflation again, as you effectively transform in what is a credit problem into an inflation problem. So I think it's all back to the book, the idea that the misconception that when you have a problem, you can solve it through monetary and fiscal policies, i.e. by printing money and debt. It's a gross misconception. We're not really solving any problems. We're doing four things. We're delaying the problems, kicking the can down the road, how far we can do that. Number two, we're transferring the problems. For decades, we've looked at currency wars and beggar thy neighbor policies. We're now shifting to trade wars. Third, we're transforming the problem into inflation and inequality and social unrest, and that brings geopolitics. And fourth, this is not a zero-sum game. It's actually enlarging the problem. So I think the thesis is being reinforced with the passage of time. And arguably, I think the tariffs could be one of the catalysts that exposes some of these dynamics. So challenging times ahead. A lot of risks, I would say, but there's a lot of opportunity as well.
That was an excellent overview, Diego. I really appreciate that. There was lots to follow up on, of course, that we can get a bit more granular and more detailed on. But I think that was a very good overview of the overall situation right now, that what is happening. Maybe we'll start with... I've taken so many notes, I have to admit. Like, maybe we'll start with the inflation debate, and what's driving inflation right now. Like, what was originally driving inflation? I think there's still a debate about it. Like, what drove inflation to like 9% in the U.S.? Was it just monetary supply, or was it supply and demand on the product, on the physical side? So I'm curious what your thoughts are on that, and like, what is driving inflation higher as we speak right now? We're sitting at 3% in the U.S. It's coming back in other places as well. So what are your thoughts on inflation here?
Well, let's start with something very simple. My inflation is different from yours and different from all the listeners here. So the idea that inflation is one single number is part of the game. Okay, they're trying to make us believe that inflation is this one thing, very precise, 2.0754. No, it's not a single number. And that's point number one. As a corollary of that, I would say that official inflation is total and utter BS. It does not represent the real increase in prices. It's a basket that is manipulated and changed. We're moving the goalpost, and third, the actual real inflation is significantly larger than official inflation, and that's kind of, if you think about the compounded effect of inflation, it's not a coincidence that we have a 2% inflation target, by most central banks. People wonder where did that 2% come from? My view is, we're all frogs in a monetary broth where the official temperature is increasing at 2% per annum, and that is sort of low enough that us frogs will stay in the water, but high enough that we will die boiled over time. And I'm old enough to believe that 20 years is not what it used to be. And what I mean by that, yeah, they go fast. Your 2% over 20 years is 40%, and that's ignoring compounding. If you look at inflation at 3, 4, 5, 10%, effectively the tax on cash, the dilution of wealth, the loss of purchase power, it grows exponentially. And this is the game. The central banks and the governments play the game where they make us believe that inflation is under control, is low, and they can effectively have a first mover advantage because they can borrow and spend, and they get the benefit of that today, and they will pay you back in with some $100 in 10, 20, 30 years that will not buy you a piece of chewing gum. And so I think this inflation it drives everything, and the big this finance monetary party that we're witnessing worldwide is being financed by cash and fixed income investors. And as you switch your brain from thinking in nominal terms, I'm earning 3% yield, that's nominal, that's good. When you factor in the real inflation is obviously a loss. And if you add taxes and other things, then this makes things even worse. So I think the entire game is all about inflation, and inflation has two very big components. It's inflation itself, like 2 + 2 = 4, but then there's inflation expectations, which is really what gets central banks really nervous. Because when inflation's expectations go up, that's when central banks start losing control. As frogs start to jump off the monetary broth, we don't longer want to be in those yields, in those bonds that are paying artificially low levels, that are effectively diluting us. And as we are forced to, or we willingly jump because of inflation expectations into real assets or equities or other things, effectively they get in trouble because they borrowed way too much and they need to refinance themselves. And this is why mommy and daddy need, the central bank needs to step in with print money and lend them at those artificial low yields, which effectively creates inflation and feeds the problem. So arguably the damage is already done. And I think inflation is like the entropy of the universe. It only goes up. And yeah, I think it's very much at the cornerstone of global financial markets. It's always been, but I think the bluff is in some ways being called. But you can see how they play this idea of deflation's the enemy, and finding, always excuses for spending more and borrowing more. Last few years was all about climate. Now it's going to be all about defense. I mean, we just need to keep the thing going and spending and borrowing. And in the meantime, all of us frogs are being diluted and paying for this party.
No, I love the frog analogy. It makes sense. 2% a year. But the question is, like, it seems like my kid has fiddled with the oven or the stove, because it wasn't 2% for the longest time. For the last 5 years, it wasn't really 2%, and the target is out of reach. Like, we got close, 2.4% if you believe the official numbers, if we go by that. But we're back to 3, and it's trending higher. Like, what's the new goal for you? Like, where do you think inflation will end up? Like, is it constantly ticking up higher? What do you think? Like, what are your inflation expectations?
I think inflation expectations are picking up, and I think they can accelerate. And once they accelerate, they're difficult to stop. And this is why central banks need to be forceful about it. And I think we've seen it. We've tried. And on the other hand, we've seen one of the, if not the biggest fiscal expansion outside of war in history. And this is very addictive and very difficult to unwind. So, you think about initiatives like DOGE or others, and of course they're needed. But if you actually do the numbers and you compare the total size of what Dodge could do relative, and you compare it to what difference does it make in basis points for the cost of borrowing of the country and financing, and it's almost negligible. I mean, what really matters here is for the governments is in some ways how much debt they have, can they afford those higher yields, are the bond vigilantes asking for them because of the imbalances. And so I think to your point, I think it's going to be difficult if we have a crisis to send yields back to zero when we all know that inflation is, the genie is out of the bottle. This has pretty deep implications for many things, including how reliable, not only reliable, but how reactive and how much defensive power does fixed income have. To make some very round numbers, if you're holding 10-year treasuries at 4.25% and yields went to zero, you could gain potentially up to 42.5% in capital gain, just doing some very simple maths. The reality is if rates don't go all the way down to zero, if let's say 2% was a new floor, then obviously the fixed income is not going to defend you as much as you thought. And if, on the other hand, inflation is so high that we actually can't even cut, which I think we will if we have the really big crisis coming. But in the meantime, I think that 2%, 2 to 3% would probably be within acceptable levels. Again, it's inflation numbers, so it's complete BS. Having had friends having many friends in Latin America and talking about this, like, guys, you're our teachers, where are we heading into? Tell us. They would tell you that 5% a year is not a problem. Is once inflation expectations kick in, it's 5% a month. When just the entire system just implodes, right? Nobody waits to buy their Snickers for a few days. So it sounds very far-fetched that we're going that way. But I think that the combination of fiscal expansion and basically the inflationary pressures that we might see through tariffs, which, in my latest newsletter, I'm sort of talking about the 3 Bs, bluff, bargaining, or belief. And I generally think that Trump is all of the above. I think he's kind of bluffing a little bit, but that would imply that he's just not going to use them. I think he will. So it moves us into bargaining, which is, look, I'm going to threaten you with this, and I will impose some, but not as much as I said, because I got away with what I wanted. Or third, is this really a matter of belief, a matter of principle? Am I going to do this because I fundamentally believe that China has been abusing the system and whatever else, and we need to defend ourselves? And whilst I think there's a bit of the three, I think the belief will prevail, and I think the market is not ready for it. And I don't think we fully appreciate what it means to the world, because it's going to hit us where it hurts most, is, as I said at the beginning of the discussion, it's uncertainty, it's inflation, it's lower economic growth, and it's volatility. It's a dangerous combo.
Yeah, let's stay on that tariff topic a little bit. And I've had that conversation in Canada. I was in Toronto earlier this week at the PDAC, the world's largest mining conference, and the debate went around tariffs, of course, because they were announced or re-announced that weekend, and they came into effect on Tuesday. But everybody says, let's just wait and see. It's like, don't worry about it. It's like it's a lot of talk. Like it's a mix of bluff and belief. Yes, it's being used as a bargaining chip, but has the market lost confidence in what Trump is saying, perhaps, or is it following a different starting to follow a different narrative? Because just this morning I woke up and I read in the FT that he's rolling back tariffs for a month, at least on the auto industry, and potentially other concessions being made as well. Like, how serious can we take that now? Like, he's only 6 weeks into the office. Like, how much of bluff, and are we calling that bluff at some point, or is the market calling that bluff?
Look, I think Trump is in a position of power. He's surrounded by very smart people. They know exactly what the consequences are, and I think they will try to, lead him out of taking measures that are too aggressive. But I think he's gonna do it, and I think he's used the word pain, which I don't. It doesn't really come out. I never hear that much from him. Like, to me, he actually knows it's going to be painful. And if you're a boxer and you want to punch the other guy and knock him out, you're going to take some punches yourself. So I think he knows that he's getting into a fight. There's going to be some punches thrown, and he's going to get hit with a few. But I think he knows, and I probably agree with him there, that that the other guy is going to be much worse off. I.e., I think in this battle, those who have abused monetary and fiscal policies most, those who rely most heavily on beggar thy neighbor policies, where they're effectively abusing monetary policy to dilute their currency and lure people into sending their money, their technology, their investments, their jobs abroad just because they're 20% cheaper. That's what tariffs do. They are like, you devalue by 20%, cool, I'll tariff you by 20%. And so I think this is sort of checkmate on those economies that have been abusing monetary policy, and in a way where it's always portrayed as a domestic issue, but it's not. The only reason we ever had negative nominal interest rates in Europe, which is a complete aberration, it's because we wanted to devalue the euro, and the Fed was at zero. To take my argument further, had the Fed been at 2%, we would have never ever seen negative nominal yields or rather interest rates in Europe. Yields is a different story, but so I think in that sense this is an absolute and relative game, and I think they're going ahead, and the question is, how bad is it going to get? And as it happens, always reminds me of this amazing philosopher Mike Tyson, who would say, everyone has a plan until they punch you in the face, which I think is one of the most important lessons for many people, and certainly policy makers. They have all these great plans until the market just punches you in the face, and we've seen it so many times, right? And effectively having to unwind things, and we know for a fact that mommy and daddy have plans, they try, they wishful think, they do things, but ultimately they always go back to the same old, which is more printing and more debt, which is effectively why, from a game theory perspective, the system is designed to finish in stagflation.
No, I think we're already in a stagflationary environment anyway. Growth in the U.S. has slowed down again, like from 3% GDP to 2.3%, and you still can debate whether those numbers are real or not, whether we're actually seeing actual growth, and whether there's underlying growth without the propping up and the deficit spending. That's something we can debate as well. But on the tariff debate, real quick, Diego, curious what your thoughts are. You hinted at it and you mentioned it earlier, but I want to get just a tad more granular. Is tariffs and inflation, like the correlation there. I've had guests on, like Peter Schiff said, don't worry about it, tariffs are not inflationary, maybe a one-time effect, but not over time. What are your thoughts, and how do you think the tariffs, especially on Canada and Mexico, will reflect on U.S. inflation numbers?
Well, I think you can create as many theories as you want. We look at history, and I think it's clear they're inflationary, and just by construction, they're going to increase prices on both sides. But I think they have second order effects, which are deflationary, because as prices go up, you destroy demand. So that's the stagflation side of the story. And given the fact that the situation is already fragile, I think that will require the monetary and fiscal response, which is inflationary again. So I think what the path looks like and how fast it happens and whatever, we'll see. But I think it's, in my opinion, it's inflationary. Whether but it's again, we were back to a point earlier. It's going to there's not a single number of inflation. It's gonna depend on who and where. But by design, I think sometimes we try to over think or overanalyze. I think this thing is designed to be again inflationary at the outset. It will have second order effects, but ultimately, I think it's bad news as it's stagflation.
Let me bring up. I just want to show a chart real quick. Nothing crazy. It's just the VIX index. I hope you can see it, Diego. But my point is, like, it's been going up dramatically. We're at 23. Personally, I'm not like the VIX is still a mystery to me. What it means. I haven't spent too much time studying it, but I've seen it back in August. It was extremely high, and we've seen a liquidity drain out of the markets, although it was only temporary. What does the high VIX number, the 23.5, tell you right now? Like you said, volatility is coming back, but what is the impact? What does that mean? And how does the consumer, is it being affected here?
So let's explain in very simple ways what the VIX measures. So the VIX is a measure of implied volatility. And for those who, to bring things into normal lingo, and so that you can calibrate whether it's high or low, a good rule of thumb is to remember that, VIX at 16% approximately, it's actually the square root 252, but around 16%, it's consistent with the implied daily move in the S&P of 1%. And that is linear. So a VIX at 32, it's roughly consistent with a 2% daily break even on the S&P, and 48 would be 3%, and so on and so forth. So the 36, 48, 60, so 3, 4, 5. Now, in that sense, the VIX is an anti-bubble. The relationship between the equity and the VIX, it's inversely related. So you have periods when equities collapse and volatility increases. It's a measure of panic. You have periods, on the other hand, of extreme complacency, where volatility is low and equities are high. And they, in fact, follow what I would define as a reflexive relationship. They kind of feed on each other. So artificially low volatility can contribute to artificially high equity prices, both through qualitative and quantitative drivers. Qualitative is complacency, mommy and daddy have our back, there's no risk. And quantitatively, you have things like CTAs or trend followers, risk parity, vol target, strategies that as volatility goes down, they lever themselves up. And as volatility increases, they're forced to unwind. And in some ways, that dynamic between the S&P and the VIX is very important. And what we're seeing with the pickup in volatility is consistent with levels that are implying that the S&P should be moving in the 1.3, 1.4, 1.5% daily, which it's actually on the higher end, but it can go substantially higher if things do break down. It has been, as an insurance, is a market that it has a lot of risk premia. So people buying the VIX or call options on the VIX, like we do, you're effectively buying options or on volatility of volatility. This insurance market, if you want to sleep at night and you want to buy these things, they come at a cost. It has a very steep negative cost, or negative carry, as we call it, and it's in fact so attractive that it can lure a lot of complacent people into going very short, and so these things can actually explode and on their own right. And as volatility increases, it actually translates into higher value at risk. It translates into higher margin calls, and it can actually trigger the sell-off and compound with moves in correlation and liquidity. So the VIX is extremely important. It's sending us a bit of a signal. Beyond the price itself, I recommend that you look at the shape of the curve. And so the VIX has futures. What you posted there is the spot index, which is not really tradable. It doesn't really mean much. When you buy the futures and you roll the futures, you buy things like the ETF. They've been weapons of wealth destruction. I mean, they really erode value in a massive way. So it's an instrument that is tricky. But what is interesting is the market is in backwardation, and both for commodities and volatility. This tends to be a sign that this is sort of for real. The market hasn't, I think a little bit like from a Darwinistic perspective, used to be a very reliable signal. So when commodity markets like oil or the VIX move into backwardation, so the front futures go above the spot futures, where the normal shape is a contango. As you move into backwardation, it's like a green light for potentially higher vol. I think a lot of people have been trading that signal, so the market defends itself and it's kind of been chopping a lot of people that are playing that. But I think it's a sign of concern. The market is telling you, I'm willing to pay more for implied volatility. It's a time to be, playing safe and buying more insurance. Realized volatility is also increasing, although it's not realizing as much as the implied. And the skewness in the shape of the curve are starting to tell you, that this could be a little bit for real. So, the next few months are going to be interesting. And I think looking at the valuations in equity markets and the absolute level of the VIX is, I'd say, moderate. It's not as low as the 15 or that we've seen the last few months with more complacency. But yeah, it's a fascinating market. We follow very closely. We trade it a lot, and it can offer probably one of the most reliable reactive sources of protection during 2 and 3 sigma events. But it's probably one of the most expensive in terms of cost and carry. So it's timing is quite important, and you need a lot of science as well into how do you play it with calls or call spreads, or it's a fascinating market. It gives you a lot of information, and it can be a very powerful part of the team.
No, absolutely. And in terms of indicators of what's to come, like I also look at the bond market on a daily basis just to see where the 10-year yield is, and it's come down. Meaning, like I would assume the bond vigilantes have left the party for now. Maybe they're outside for a smoke. I don't know what they're doing, but it seems like they've retreated. Just a couple of weeks ago, we did interviews talking about where are the bond yields headed? Is it 5%? Is it 6%? Now we got to talk about 3% almost. Like it's trending down, the yield. What is that telling you? What are you making of that?
Well, first of all, I think there's clear alignment from the government to have those yields as low as possible. Can they do it on their own? Theoretically not, because they're borrowing ever so more. If the central banks come to the rescue, and the last round of cuts, we saw something quite interesting, which is, the Fed was cutting the front end, and the market was saying, no way. and we had a steepener. And so as front end, which is controlled by central banks, is going down, the back end, which is more free, is going up, saying, guys, you're just going to create more inflation. You're going to have to later. To some extent, those flows in the back end, again, whether they're vigilantes or real money flows, we're still at nominal levels. We've earned our way to have a bit of protection in terms of duration. So, if equity markets do sell off hard, then I think fixed income will potentially come to the rescue in at least in partial way. So in that sense, it makes sense that the flows will go in there. The other thing that is quite worrying is if you think about all the talk about Japan and hiking interest rates and the big level of debt that they have, and potentially the repatriation of money into Japan which arguably will be buying JGBs at higher yields. And some of that could come from selling treasuries, whether it's China or Japan or others. And as you get higher yields, you have that pressure coming from flows. I mean, yesterday, with the big announcement in Germany, we saw the 10-year going up by 25 basis points. That's, approximately linear form would be 2.5% move in a huge market. So the long end is not 100% free float. It's not telling you exactly what the expectations are for where rates are going to be or inflation. There's a big driver of flows and people buying and selling, and I think there's a lot of two-way traffic. But ultimately, if things happen, I think they become safe havens, and money flows in there away from other pockets, and yeah, so they have a role to play. The question I was asking at the beginning is, if inflation is the problem, then is it really consistent? Does it really make sense that you flow into them when the underlying problem is inflation? So that risk of cold drawdown, fixed income down, equity down, it's very vicious. And I always use the analogy that a portfolio construction, portfolio is like a football team, a soccer team, right? I'm Spanish, you're German. We speak football, I think. And I would argue that equities are the striker, fixed income's the defender, and volatility is the goalkeeper. So if fixed income's doing its job and the defenders are defending well, you don't really need a goalkeeper. But if things really go sour for whatever reason, or the defender is like the Bund with negative nominal yields, I used to compare him with rest in peace, the legend Beckenbauer, right? I used to call Franz the Bund Beckenbauer, because like one of the best defenders in the world, but at negative nominal yields, the guy's 75. He's not going to be able to defend that much. So I think it's a critical part of the market. It's a big pot. It has all these dynamics that we discussed with inflation. I mean, nominal versus real, flows, yield curve control, vigilantes, inflation. It's a fascinating market, and you're right. I mean, we need to pay close attention to it. But in some ways, it might be telling you something that it's like, okay, let's pile into this because I don't like the other side, or you could have very different interpretations, like, oh, inflation's under control, and yeah, let's just, this is a good place to be. I think there's a bit of truth in all the thesis. Time will tell, but yeah, I think at the outset, inflationary pressures are bad for bonds. If the crisis gets bad, you will get that bid, and how far can it go in terms of protection is a question, but I think it'll be limited, and ultimately the answer will be more of the same, which effectively brings more inflation, and again it puts the pressure on. So the end game is currency devaluation. The end game is, with 100% certainty, all the monetary and fiscal abuse ends up diluting the currency. And whilst lots of people are very negative on the dollar, it's a bit of a domino. It's who is weakest, and we've seen what's happened in Japan, with their monetary and fiscal abuse. I personally think China is much more vulnerable to a much weaker yen. The euro is loving the fiscal expansion, and I think it's in some ways reflecting the unwind of probably one of the most consensus views that was euro lower. So there's a lot of pain on the street with euro going from 103 to 108 in a few days. We haven't seen such big moves in a while, and so it brings this huge question of, is the dollar a safe haven or not? And with the world polarizing and all the things that are happening, I think yes, but that would bring us into a topic we both, I think, love, which is gold. Which is, I think gold ultimately in this currency game, that's the one you want. And why I think gold, when I wrote my book, it was gold. The subtitle of the anti-bubbles was Gold's Perfect Storm. And my line was, gold has a few $100 of downside. It has a few $1,000s of upside. And I think it's going to be a market that I think has significant upside. I mean, for multiple reasons.
Yeah. I'm just sharing a meme I saw it this morning, and you just touched on that, and it's exactly like Le Shrub shared it on X. But euro parity, where's that euro parity? You got the goose chasing the forecaster. I just love that meme. It made me laugh this morning while I was having my morning coffee. No, but you touched on my last topic that I want to touch on. As I said, or as you mentioned, you're the author of Anti-Bubbles. And maybe to change momentum a little bit, Diego, as well. I mentioned it to you before hitting the record button. It's like, do you sometimes feel like the boy who cried wolf? Back in 2017, you put your book out, The Anti-Bubbles. Bubbles are visible everywhere. We've been pumping money into the system. It's only gotten worse with COVID. Lots more QE, a bit of QT, but more stealth QE than QT, to be honest. Are you worried that you're crying wolf? And B, like, what is the anti-bubble, and how do we protect ourselves? You touched on one of the solutions already, of course, but are you worried? Is that a concern of you that you're the boy who cried wolf?
Look, no, it's not a concern to me. I see myself more like a doctor diagnosing a terrible disease to a friend. I feel that as a doctor, I want to be correct. As a friend, I want to be wrong. And I generally believe that the thesis that I put out in 2017 has not only survived, is actually strengthened. And whilst there were things that nobody could anticipate, like the pandemic or wars or other things, it kind of reinforces the thesis. You know, every single time that we've had a crisis, call it a regional banking crisis in the US, I mean, nobody remembers that. We had several failures bigger than Lehman, right? And it was a blip. Why? Because they came in, they changed the rules, they printed and borrowed, and end of story. COVID was obviously a whole new level. But even the wars, you know, in Europe, we have this huge problem with energy, and we subsidize energy, which means, okay, I become totally price insensitive, and I am going to literally send prices to infinity because people at the pump are price insensitive. And I'm going to make sure that I have those molecules so my system doesn't stop. And ultimately, all it does is that those energy subsidies transform an energy problem into an inflation problem, because you've just diluted the euro and increase your debt. So I think the thesis has been reinforced, but it's fair to say that, you know, I feel like I'm the goalkeeper of the football team, so it'd be ludicrous for me to be trying to score goals. I know my job, but this is not a game of conviction. It's not what, you know, if you're the goalkeeper, you're like, oh, I think they're going to attack in the next 5 minutes. You have a role to play. You're under the goal, and you have to be ready and warmed up and ready for the other team to attack. So in that sense, I will be, the only thing we do is focus about how to defend the portfolio. And we do that both in you know, volatility and tail risk mandates. So for those who are investors, they can look at Igneo usage or strategy at Quadriga. But we have another strategy called Aqua, which is effectively long only equity with the overlay. And it shows you, that links to my work at Imperial College and the academic work that I do, in the power of creating the team. You know, how the upside alpha of equities with the downside alpha of protection and the rebalancing alpha can create really amazing teams. So last year, with S&P up like 24, 25%, our strategy was up like 28. Something that is strange, because it's like, how can a strategy that has defenders and goalkeepers beat the strategy with only attackers in a bull market? And it shows you the power of defense, right? I use the analogy of Formula One, where, you know, the Formula One, the engine is your equities, is your power, is your speed. And theoretically, the brakes are there to slow you down and keep you safe. So our linear monkey brains say, oh, if I have a car with brakes, it'll be slower. And the answer is no, we are actually way faster because the the fact that you have good brakes means you can go faster for longer. You can avoid the accidents, and that's exactly what's happening. So I think for anybody that is, if you ask me how do we play these markets, I feel that with a 5, 10, 15, 20-year view, inflation is one way. I think it's hard not to be invested. And as a corollary in risk, as a corollary, I think equities have to be a core part of the portfolio. I think fixed income has a role to play, but the juice is less. And I think in the long term will be big losers from inflation. So how do you marry that? I think the idea is you have to be long equities with protection, and that has to be accumulated and monetized. If you don't monetize it, it's there's no point in buying it. And that's kind of the role we play for investors, and how we're trying to address what is in a sense an extraordinarily difficult environment, of high risk and high inflation, but also high opportunity. So yeah, if anybody's interested in hearing more, just you can follow me on LinkedIn or Twitter, or reach out directly, and we'll be happy to add people to a distribution list. And but yeah, fascinating times. let's see how the movie plays
tell
out.
me about it. I'm running a podcast on this topic, so tell me about it. Maybe one last question. You touched on it already, but it really is gold. I just want to get a bit more insights here from you. Gold has run almost to $3,000 late last week. I started calling gold meme gold, and it was right before gold sort of took $100 nosedive and corrected a little bit. It seems to be heading up higher again. But what are your thoughts on gold? Does it still have that role right now, especially at 3,000, that it can protect your wealth? You said a couple of $100 downside, thousands of dollars upside. Does that still apply at 3,000?
Absolutely. I think gold, it's a long-term play. I think if you look at the screen too much, you're going to completely lose sight of what's happening. I'm an extraordinarily big picture kind of person. I think you need to think about what's happening in the true macro scale. And these pullbacks and move up, it's noise as far as I'm concerned. There's a lot of poker players on the table that are making these quick bets in and out, and I'm sure they're really good and they probably make a lot of money. Good luck to them. I'm a chess player. I play long term, and I think gold is extremely well positioned. The fact that it's 1, 2, 3,000 is just a number. If you think about it in many other ways, it's hard to say what's the fair value of gold. But look, I think it has a role to play. I think if we go into crypto, that we'll need another hour or so to discuss. But I'm very much a gold guy. I like the physical nature of gold. I like certain things. I've been very skeptical of more of the wealth effect created by thin air, like the fact that I know this is open a different debate, gold, Bitcoin, blah blah blah, is different, but the entire meme coin and the Trump coin, and it's just so ridiculous in itself, that you can actually create those 30-40 billion of wealth effect out of nowhere. And it's so obvious why there's a massive conflict and why they want crypto higher. It's wealth effect. It's making people feel rich, is to keep that thing. And there was one of the CEOs in a dinner the other day with the CEO of one of the biggest banks, and which remain nameless. And then this guy was like, we're amazed, when crypto had this 500 billion, wipeout, and it's like, where did the money go? It's like, we were looking at fixed income and equities, and I was like, excuse me, you know where it went? It went where it came from. It never existed. And that's wealth effect, right? So I think in the case of gold or paintings or wine, you could argue that, it's just, the beauty is in the eye of the beholder, or it's how much it's worth. But I do think gold has been around for a long time. I think it's some central banks are betting on it. I think part of the strength in the dollar historically has been precisely they've dominated, the amount of gold back in their currency by many multiples. Every other central bank, I think it was 10x the second bank. And so I think in that sense, look, gold it has some unique characteristics that make it what it is. It's not the only solution. It's going to have big drawdowns. It's going to be volatile. But if you actually think about where do I park my money, in or some of it relative to euros or dollars or yen or yuan or sterling, I think in a 5, 10, 15, 20 years, it's hard for me to see a scenario where gold is not done very well against those currencies. But so will real estate or other real assets as well. So it's not just that I'm in love with gold, which I I like and I am in some ways, but yeah, I think gold's unique. I think we could easily be looking at 10K in because the moves, when I used to trade gold, I started my career in 97, 98. It was $250 and the bid offers were like nothing, and as the market gets larger, the bid offers get wider, the positions get bigger, and so we'll see where it takes us. But look, we continue to believe in gold. We play a lot in the option space. There's really fascinating opportunities in playing gold versus other assets as well, and so it's a lot of fun. It's a great asset to own. It gives us a lot of opportunity in many ways, but again, don't like always, don't beware of leverage. Just make sure people are prudent. They play this for the long term, and I think if you do that, I think gold will probably do well in the portfolio. But if people get too carried away with too much leverage, it can be a very vicious animal as well. So yeah, I do think that this move feels like much safer hands than before, much long-term oriented, less spec. In fact, I think a lot of people completely missed out. But yeah, we'll see where it goes. But yeah, good, fantastic asset.
Oh, absolutely. That's we live by it here at SOAR Financially. So, Diego, what a wonderful conversation. I tremendously enjoyed the last 52 minutes here with you. Like we can follow you on X, but where else can we send our viewers? We'll put the links down below, of course, as well.
Yeah, look, I don't contribute as frequently, but I do occasionally. So on X, you have my connection at Parrilla Diego, RRLL. Feel free to reach out through LinkedIn as well if if people want more information about what we do and the strategies or the newsletter. And yeah, just feel free to reach out. We always keen to listen to the other side, and we try to fall in love with the problem, not the solution. So very, very keen to help out in with what I think are very big problems. So do look forward to connecting with your audience, and thank you for the time. I enjoyed the discussion as well, Kai.
Yeah, fantastic. Thank you so much for coming on, Diego. We'll have to do this
My
again
pleasure.
soon. And maybe we'll get to meet in person one day. I'm still looking, maybe I'll be down in Madrid on the 15th. I still need to get travel approval. So it'd be great to catch up.
Safe travels. I live between London and Madrid, but we might catch each other.
That'd be fantastic. Diego, thank you so much for your time. Everybody else, thank you so much for tuning in here to SOAR Financially. And I just decided, if you made it this far through the interview, you deserve to be rewarded. We're giving away one of Diego's books. So make sure to put down a book down in the comments, and we'll just randomly draw one of the comments and ship the book to you. We'll reach out, so make sure to check your inbox after the draw, and to put it down below. We'll do that. The anti-bubble. We'll give that away. It'll help you educate yourselves about bubbles and how to protect yourselves once the bubbles start to burst. Thank you so much for tuning in. Please subscribe to the channel. We'll be back with lots more here on SOAR Financially. Thank you.